solving a critically important problem, which is leveling the playing field for retail investors. Retail investors don't have the same tools as large institutions and underperform the broader markets over time. I decided to apply my experience to try to address this critical societal need. The narrative that markets are rigged and that big institutions steal from little girls and guys out there is mostly not correct. That narrative exploits fear and reduces rich complexity to a simple fairy tale. Find a victim, finger a villain, promote a hero. We don't live in Sherwood Forest. Our markets are well structured, highly competitive, and expertly regulated. There is plenty of room for improvement, no doubt, particularly as we adapt to an ever-changing world. One needed improvement is to deliver institutional-grade capabilities to retail investors, including in the areas of data, knowledge, access, and influence. And that's our mission at All of Us. Let me be clear that we currently are paid for order flow at All of Us. And because we believe in radical transparency and alignment, unlike some other brokers, we share this revenue with our customers. We believe this aligns our interests with our customers and helps educate them about how markets work. Some view disclosure as a point-in-time regulatory requirement. We take the view that transparency is a real-time foundation for our entire business. PFOF is not a necessary component of our market structure, but it is an effective way for markets to operate and should not be banned without careful consideration of its costs and benefits. Importantly, regulation requires all market makers to trade with customers at or better than best prices available on exchanges. And there's a comprehensive execution audit trail for brokers and regulators to monitor. As we consider PFOF in this light, there are some truths to consider. First, market makers and exchanges all provide valuable services and need to be paid for them. Market makers provide liquidity, price discovery, and critical customer service. Exchanges provide, among other things, order matching and settlement services. These services cannot be provided for free. Second, market makers are indifferent between PFOF and price improvement because the net price to them is the same. Brokers care, however. They also need to be paid for providing services in a highly competitive environment. If we prohibit PFOF, commissions will likely increase and valuable retail innovations such as fractional shares may become uneconomical. Last, some claim separating retail and institutional flow harms retail investors. In fact, because market makers value retail flow more highly than institutional flow, if we force them into the same market structure, and this is important, the average price received will be worse for retail orders and better for institutional orders than it is today. In terms of gamification and social investing, social media platforms and gamification are powerful forces, and like most implements can be used for both good and bad purposes. But society is evolving and younger generations want products and services delivered via social media. Good gamification and social investing can drive financial literacy, education, and encourage healthy behavior, such as regular saving and investing. And that is a standard we hold ourselves to at All of Us. Brokerage is highly competitive, and innovations in social investing will continue to emerge. The right regulatory balance is to encourage innovation for the benefit of retail investors while ensuring investor protection. Our markets can be a wonderful means for Americans to invest and build wealth. But as the GameStop activity shows, our markets can be improved, and efforts to educate and improve experience of retail investors are critical as markets become increasingly accessible and more people invest for the first time. I appreciate this opportunity to appear before the committee today. I look forward to answering your questions from an entrepreneurial perspective at the appropriate time. Thank you.
Thank you, Mr. Rujic. Now I will call on Mr. Pivovar. You are now recognized for 5 minutes.
Good morning. Thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee for inviting me to testify today. My name is Mike Pivovar, and I'm the Executive Director of the Milken Institute Center for Financial Markets. Previously, I had the pleasure of serving as a visiting academic scholar, senior financial economist, commissioner, and acting chairman of the Securities and Exchange Commission. Thank you for calling this second hearing on the lessons learned from the trading activity in GameStop and other so-called meme stocks. In the first hearing, members of this committee identified a number of issues that the SEC could prioritize in its regulatory, compliance, and enforcement roles. I hope that my testimony today will be helpful in guiding some of those priorities. Now, the Commission has already said that they're reviewing actions taken by regulated entities to determine whether they may have disadvantaged investors or otherwise unduly inhibited their ability to trade certain securities. The SEC's Division of Examinations has said that one of their 2021 examination priorities will be to examine broker-dealers to assess whether they are meeting their legal and compliance obligations when providing retail customers access to complex strategies such as options trading. And the Commission has said they are investigating whether abusive or manipulative trading activity prohibited by the federal securities laws occurred during this episode. Now, I have complete confidence that the Commission and its compliance and enforcement staff will identify and pursue any evidence of noncompliance or wrongdoing. Accordingly, I focus my testimony on the regulatory policy issues that have been raised in the aftermath of the January trading. The first part of my testimony focuses on achieving more equitable access to investing in private companies. The second part focuses on improving 3 specific areas of market structure and market infrastructure policy. Here's a quick summary. Retail investors enjoy more choices and face lower costs when investing their hard-earned savings in public companies than ever before. Retail investors have taken advantage of these beneficial trends over the past few decades. The fraction of U.S. households that own stocks, either directly or indirectly through funds and retirement savings accounts and pension funds, increased from less than 1/3 in 1989 to more than 1/2 in 2019. Now, low-income households saw the biggest gains over this period, but they still lag high-income households in public stock ownership rates. In 2019, 15% of households in the lowest income quintile held stocks in public companies, compared to 88% of households in the highest income quintile. Now, while I'm not aware of any statistics on ownership rates by household income level for private companies, the gap is undoubtedly worse because SEC rules currently effectively prohibit low-income investors from investing in this high-growth sector of the economy. Accordingly, I believe the SEC should revisit the accredited investor definition and solicit public feedback on achieving more equitable access to investing in private companies across all income levels. Based on that feedback, the SEC should engage in rulemaking to open up these investment opportunities to all Americans. I also recommend that the SEC should, 1, evaluate whether and how to move to a shorter trade settlement cycle. 2, study how payment for order flow is working in a zero commission environment with a focus on order routing and best execution requirements. And 3, evaluate various alternatives to increase regulatory reporting and public transparency in securities lending. My written testimony provides an in-depth discussion of each of these issues, and I'm happy to answer any questions you may have. Thank you again for bringing attention to these critical issues and for the opportunity to testify before you here today.
Thank you very much, Mr. Peterbar. I now recognize myself for 5 minutes for questions. Last month, the committee reviewed the actions of various market participants surrounding the volatile trading in GameStop and other stocks. We discussed how Robinhood, which caters to retail investors, earns nearly all of its revenue from selling its customers' orders to firms like Citadel, raising questions about who really is Robinhood's customer. Robinhood claims its customers are served best because it doesn't charge any commissions, but it cost its customers more than 34 million last year, and Robinhood paid 65 million to settle an enforcement action related to selling its customer stock orders. I understand the allure of Robinhood. When I first learned about Robinhood, I thought it showed great promise. Ms. Goldstein, payment for order flow, which was pioneered by the fraudster Bernie Madoff, allows brokers like Robinhood to make huge profits by routing their customers' orders to market makers like Citadel instead of sending them directly to an exchange like the New York Stock Exchange, even if it means brokers won't obtain the most favorable trading terms for investors. Can you please explain whether you think these disturbing conflicts can ever be truly mitigated in such a way that guarantee brokers and other market participants are acting in the best interest of their customers?
Chairwoman Waters, thank you for the question and thank you for holding this hearing today. I think it's a very, if we look back to 2016 and the Obama administration, the Securities and Exchange Commission wrote a memo to its Equity Market Structure Advisory Committee, and it identified a series of potential conflicts with payment for order flow. They thought it might interfere with a broker's duty to receive best execution for their customers. They thought it might create perverse incentives for them to route their orders to market makers instead of to lit exchanges. And they identified that it may, in fact, be obscuring the true costs that customers are paying for their order flow. I like to liken it to sort of Facebook, right? If you are not paying for something, that often means that you yourself are the product. And Robinhood, many years ago, made upwards of 80% of their revenue from payment for order flow. And that SEC enforcement action that you identified, they pointed out that they hid that information for their customers after the publication of the best-selling book Flash Boys made payment for order flow somewhat unpopular. They took it off of their frequently asked questions page. So I do think that the Securities and Exchange Commission should revisit all of those questions that they had previously in 2016 in the Obama administration. They should ask, should this practice be prohibited? Is it too confusing? Does it mask the true cost of the trade? Or should brokers be required to pass these payments on to their customers, which could be another way to address the problem?
Thank you. I'd like to ask you, you indicated that you had at some point been involved with Robinhood, that you had done some trading, and that's how you became very knowledgeable about how they operate. Could you tell us what that experience was?
I'd be happy to, Congresswoman. I've used Robinhood. I've used a number of other brokerages. I was quite frankly very shocked at how quickly I was able to get set up for trading on Robinhood. I happen to have a lot of expertise in options because I have a history of working with options trading desks on Wall Street. But even with that expertise, it's usually much slower when I've tried to use other brokerages to get permission to trade in certain kinds of options tradings, like what are known as option spreads. But in Robinhood, there was no friction. I did not have to fill out any kind of complicated forms. I was honestly quite surprised at how easy it was. And I do think that the folks that have criticized Robinhood for the gamification of it have some, there's something behind that. When you place your first trade, this confetti bursts on your screen. There's lots of recommendations about the products you trade. It says, oh, you traded this, so you might be interested in this other company. And so I do think there are a lot of questions about the ways that Robinhood may be enticing people who may not have the needed expertise to trade, for example, option strategies where you can lose a lot of money. They call spreads put spreads. So I was quite frankly pretty surprised at how different it was from other brokerages, especially when it came to how much outstanding risk I had. I think it's very simplified, and that's often said is it a benefit, but it's simplified in a way that can be very dangerous if people don't understand their risk.
Well, I thank you very much for the testimony. I now recognize the distinguished ranking member, Mr. McHenry, for 5 minutes for questions.
Well, thank you, Madam Chair. And Mr. Pivovar, I'd like to actually go to you. And I just want to take a step back and look at the evolution of retail investing over the last decade or so, and the impact of rules prohibiting everyday investors from investing in high tech, high growth, or a number of segments of our economy that are currently prohibited. So what was the rationale behind these rules, and what impact did the prohibition have on investors and investment opportunities, the accredited investor standard in particular?
Thank you, Congressman McHenry, for that question. So the original rationale for this rule was quite well intended. It was an investor protection rule. And the idea was that it would protect investors from investing in riskier securities. Now, I question the premise of that as an economist, right? I'm only the third PhD economist to be a commissioner at the SEC. Most of the SEC commissioners and staffers are lawyers there. They tend to think of the risk of securities in isolation, the risk of any particular security. But when I look at it through the lens of an economist, what we know is that individual retail investors and institutional investors don't hold securities in isolation. They hold portfolios of securities. And so once I apply the principles of economics to this, you can add riskier securities to your portfolio, which, as you point out, also tend to be higher growth, higher expected returns to your portfolio without increasing the overall risk that you're facing within the markets. And what you're essentially doing is limiting the upside of these individual portfolios. I believe you're on mute, Congressman.
I thought I unmuted. Here we go. So So what does that do to exacerbate? Does that have any impact on inequality? Does that exacerbate inequality?
Absolutely. We know that younger companies tend to be higher growth. And so what we've seen over the long term, over the last 20 years, we have about half as many public companies as we did about 20 years ago. And so by limiting non-accredited investors to that public company universe, we're limiting to them to a smaller portfolio of securities, right? We know that there are fewer companies that are going public at all. We also seen a trend that growing companies are going public later in their life. So when they do finally become public, a lot of that growth opportunities to invest in them have gone by the wayside, and individual, retail non-accredited investors didn't get the opportunity to invest in those companies during that growth cycle, whereas the accredited investors have had that opportunity, which by the definition of accredited investor is somebody who's already rich, so the rich get richer.
So it sounds like this dual track system is outdated and the rationale is outdated. Mr. Gruchik, let's go to you. Technology platforms like yours are attempting to democratize investor access to public markets, making it easier. And we've seen this move over the last really 50 years in this country, attracting a whole new class of investors. But that's been heightened because of technology, obviously. Do you think that fintech could be similarly useful to everyday investors if they were able to access early stage investment opportunities?
Yes, absolutely. And there are a lot of platforms now, the crowdfunding platforms that are opening up this space, and the recent regulations, I think, are very helpful. The changes to the regulations to open up this space. I concur that the accredited investor rules are outdated. I've always been very uncomfortable with them. The concept that we don't have equal rights as citizens to participate in investments has always troubled me. I do actively participate in the private markets as an accredited investor. I invested in Facebook before it went public. I've invested in other companies. That really should be accessible to everyone. At the same time, if we are to look for investor protections in this area, they should come in the form of assessing people's understanding and ability to make these investments, certainly not based on their wealth.
All right. Well, it sounds like we need to update our system and allow more people access to investment opportunities. And Mr. Pivowar, I'll just close in saying I agree with your assessment that payment for order flow, and given the regulation of our market structure as it is, there are only trade-offs. There's no simple win-win. We need good disclosures, but it's all a series of trade-offs. So yield back. Thank you.
Thank you very much. The gentlewoman from New York, Mrs. Velasquez, who is also the chair of the House Committee on Small Business, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Kelleher, Robinhood seems to have perfected the gamification of trading, providing the user with the perception that investing through the app offers recreational gameplay with little or no downside risk. First, are you concerned with the gamification of the Robinhood app? And second, do you believe Robinhood's disclosures are properly balancing the potential downside risk of investing, including the risk of substantial loss and the more enticing claims of profitability and the ease of trading?
Thank you for your question. And yes, we should all be concerned about the gamification of the Robinhood app. Its primary function is not to get people to invest, it's to get people to trade. And it wants people to trade because the more people trade, the more payment for order flow it receives, the more revenue it gets, the richer they get, and the bigger the IPO that they've got in the pipeline coming. That's what gamification is about. And the Professor Bogan has very well stated the academic literature about so many aspects of the app driving people to thoughtlessly engage in trading rather than thoughtfully engage in trading. One of the big problems we have here is, unlike Mr. Piwowar, we do not have PhD economists applying economic principles here. We have a game-like mechanism that's meant to actually cause people to drop their defenses, to not think at all about losses and risks, and to only think about gains and trading.
So,
And
Mr.
everybody should worry
Kelleher,
about that.
as we consider issues associated with gamification, what type of reforms would you recommend?
Well, I think that one thing that should be done, and Professor Brogan again has talked about this, is the aspects of these apps that actually are scientifically designed to hit the endorphins of the trader, which is to say, to short circuit and cut off thoughtful processes that people engage in, balancing risks and rewards, balancing the need to do something versus the reflex to do something because something unconscious has been engaged. And indeed, as Sal Arnott showed in his testimony, if you look at the other platforms, they actually thoughtfully present material on, for example, options and the risks of options. You don't see that on the Robinhood app. And indeed, on the Robinhood app, do you know one of the most often asked questions, according to an article I read, on the app is, what is a stock? There's another frequently asked question is, what is the S&P 500? So you have a base of customers with extremely low knowledge who are being intentionally activated unconsciously to trade more and more often for the sole purpose of enriching Robinhood.
Thank you. Mr. Kelleher, during last month's hearing, I also brought up the important issue of short selling. While I said at the time and continue to understand that short selling has legitimate purposes, I also said that too often I have seen the strategy used against working individuals and families. First, against the people of Puerto Rico, and now here with the GameStop craze. Currently, large investors, including hedge funds, must disclose their long positions when they own 5% or more of a company's share, but not such disclosure is required for short positions. As we consider reform, is this type of disclosure for short positions something you will support?
There absolutely should be greater disclosure for short positions, both on the institutional investor side and on the broker-dealer side. And that disclosure should be increased in terms of frequency and particularly in terms of content. There's a great deal of synthetic shorting happening in these markets with total return swaps and other synthetic products that actually disguise and understate what we even now publicly know. So across the board, in terms of the actual entities, in terms of the timing, and in terms of the content, disclosure should be increased. And it should actually be pretty well studied. But regardless of the outcome of that study, we need more information to the market so that people can act more informed.
Thank you, Madam Chair. Thank you, Mr. Kelleher. I yield back.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. This is a question for both Mr. Grujic and Mr. Pivovar. Just briefly, are there any regulatory barriers to help facilitate increased access for everyday investors that you see that we in Congress could work on removing? Mr. Grujic.
Yes, there certainly are. As I stated in my opening, I think we always have trade-offs, and so there's always going to be frictions where regulations exist, and sometimes the benefit exceeds the cost. In particular, the ones that trouble me are the accredited investor rules we've just touched on. I think that while not my area of professional expertise, I've really felt that is highly limiting to the opportunity set for retail investors. I also think that over the next decade or two, expansion in private markets is going to be a greater opportunity for retail investors than public markets. And I emphasize that that's an area that perhaps is the most important.
Great. Mr. Pivovar.
Yeah, thank you, Congresswoman Wagner. I agree with Mr. Gertzik about revisiting the accredited investor definition. That's the most direct way that the SEC can deal with it. There's a couple of indirect ways also. Is if people are still uncomfortable with investors investing directly in private companies, there's a way to address this indirectly. And I'll note that Congressman Anthony Gonzalez has had a bill last Congress that would open up the ability of closed-end funds to invest in private funds that invest in private companies. I think closed-end funds, a particular type of them is called interval funds, would be a particularly useful investment vehicle. And then people would have comfort that, that it would be, the investor would be protected through a regulated investment advisor. And there's a number of other things that the commission can do along those. So they could do it directly and indirectly.
Thank you. Mr. Grujic, if payment for order flow were to be banned, how would that impact the commission-free trading that millions of Main Street investors who are currently benefiting from it in order to save for retirement, buy their first home, or pay for their child's education? How would that be impacted?
Well, these things are always somewhat indeterminate. My expectation, it depends on the innovation that occurs around the changes that happen. My expectation is that with brokers needing to earn a return, commissions would return. The problem with commissions in their former implementation is that they also had the same misalignment issues of trying to promote more trading in order, more trading correlated with higher revenues for brokers before there was any payment for order flow. So this highlighting of payment for order flow as having that misalignment issue is really not any different from what the state was. Less optimal about fixed commissions. One is that they don't reflect the true economic value of the underlying trade. So if a large trade and a small trade are both build the same fee, that is not an economically sound approach. Secondly, I believe fractional shares, which haven't gotten a lot of discussion here, are extremely important and valuable to retail investors. We talk about giving smaller investors access to markets, but we have securities that trade at very high prices. How do we expect those investors to be able to buy an Amazon or another high-priced stock? And one way that we can do that is we can offer fractional shares, and we do. And we, as an industry, we've made great strides there. That also allows a retail investor, even with a small portfolio, to rebalance it in ways that are optimal. And so I also worry whether fractional shares would become uneconomical if we removed payment for order flow.
Interesting. Mr. Pivovar, is it possible for payment for order flow to be aligned with the SEC's best execution requirements for broker dealers when routing orders for retail investors?
Yes, absolutely. And Mr. Grujic brings up excellent points about how payment for order flow can't be looked in isolation. You need to look at unintended effects of banning it. In fact, the SEC enforces its best execution obligations all the time and are continually looking at these issues. And in fact, as I pointed out in my opening remarks, one of the exam priorities for the Division of Examination at the SEC is going to be looking at to make sure that brokers are fulfilling their best execution requirements. And as Mr. Grujic points, in a commission-based world, you just have a different type of contract.
Thank you. My time is elapsed, and I yield back, Madam Chair.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
American wages are too low. Those opposed to unionization, progressive taxation, and other efforts to put money in the hands of working families have a solution. Tell working families, go play the stock market every day, every hour. And if you don't get rich, if you can't get by, don't demand higher wages because it's really your fault. You're a bad day trader, which is the same as being a bad person. Casinos and lotteries pay high taxes. Real investment in equities finances our economy. It's hard to see how day trading has any ascertainable social benefit. I want to commend Dr. Bogan for pointing out that zero commissions does not mean zero cost to investors. It just means zero disclosed costs. The main cost is the spread, the difference between the bid and the ask. And the gamification drives you to this, but also the illusion that Robinhood is able to create that there's no cost to you because there's no commission. And Dr. Mogan points out the gamification, the nudges, the confetti. And I would just want to say that if you want an exciting video interface, go to GameStop and buy a video game. It's not a reason to go to Robinhood and buy GameStop. Mr. Keller, thank you for pointing out that just saying investors have never had it so good is hardly an answer. I'm not going to send a love letter to T-Mobile because my phone is cheaper and better than it was 20 years ago. I expect to get the lion's share of the benefits of technology. Now, during the last hearing we had on this subject, I asked the CEO of Citadel, Ken Griffin, whether the customers of Robinhood get the same trade execution quality as customers of Fidelity, a broker that does not accept payment for order flow. Mr. Griffin twisted, turned, filibustered, did everything to avoid giving me a straight answer. That's why I want to commend the CEO of his, perhaps his number one competitor, Virtue Financial, who went on CNBC and said, and I'll quote, "Overall, though, during the course of a month, we will provide more price improvement to Fidelity than we do to Robinhood." Now, of course, Fidelity charges zero commissions for online trades, but Fidelity does not accept payment for order flow. So clearly we could have no payment for order flow and zero commissions. Further, payment for order flow offered by market makers was banned in the UK almost a decade ago, and their markets continue to function well. Is there any reason the US shouldn't take a similar step of banning any payment to brokers when they're acting as an agent for directing their order flow? Go.
No, Congressman Sherman, thank you for your question. It can be banned and it should be banned. It does not mean that the intermediaries will not be well compensated. They will still be well compensated because they can be compensated on a spread. And what it would do if you ban payment for order flow, it would have the additional benefit of driving a lot more trading to the public markets, which now are less liquid and have less trading because so much of it is being skimmed off, about 47%. And we detail this in Appendix C of my testimony. 47% of all the trading is flowing into dark, unregulated, low investor protection, non-disclosure markets by these internalizers who are using legalized kickbacks and payment for order flow to executing or to retail brokers like Robinhood. And everybody's getting rich, but that money's coming from somewhere. And where it's coming from is the pockets of retail investors.
And I'll point out that even if I get a good execution of my trade in one of these dark pools, the country is deprived of information about that trade that would be available if we traded on a market.
Exactly.
I'll just also point out that we live in a strange world where some people get best execution and some get price improved best execution. And I yield back.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, and I appreciate the opportunity to hear from our witnesses today. Mr. Pivar, the payment for order flow process was in use when you were a commissioner at the SEC and well before that. You suggest in your testimony that the SEC should hold a roundtable to discuss payment for flow, order flow, I should say, and its possible effect on order routing and best execution obligations. Could you explain to us what factors the SEC might weigh in evaluating if any changes should be made to the practice of payment for order flow based on your experiences?
Yes, thank you, Congressman, for the question. Yeah, so what the SEC would do in that case would open up a public forum and to ask for public comment on it. As much as we think that the agency is staffed with experts, and certainly are, the best available information they have is oftentimes given from market participants and investors. And through that process, what they would do is lay out all of the alternatives, ranging from keeping payment for order flow the same to, on the other end, banning it, and anything in between, either maybe changing the regulations around it or improving disclosure around it. And then what they would do is, once they have all those alternatives on the table, explicitly look through the costs and benefits of each, and then choose the appropriate regulatory path forward based upon that. It may end up one extreme or the other. It may end up somewhere in the middle, or it may end up, things have changed as they are. One of the reasons why I suggest they look at it now is because the SEC has not done a deep dive on it since we've entered into a zero commission environment. And so, of course, they should be looking at this in terms of how the market and technologies change.
Mr. Kruvacek, you explained in your testimony that separating retail and institutional investment flows largely benefits the retail investor. Could you elaborate on why the retail investor would be worse off if both retail and institutional investors receive the same average price?
Yes, happy to. So on the one hand, retail flow is much more benign to market makers because of its characteristics. It tends to be smaller orders. They tend to be more dispersed. They tend to be less correlated. There have been some experiences with social media and gamification and Reddit that have caused the behavior to be more clumpy. But generally speaking, market makers love payment for order flow on the one hand because of how it was unsystematic and small. On the other hand, it's been stated, and I want to speak to this, that it's dumb flow, and that's why they make more money on it. The reality is that investors do need to be educated and do need to make better and better investment decisions. But their orders will still be smaller, and because there are a larger constituent of people, there will be more diversity amongst that order flow. And institutional flow is very different. Institutional flow is often sliced up, big flows that happen in small pieces that are very adversarial to a market maker. When I ran high frequency trading, we could not get access to market makers. We had to go directly to the exchanges. They did not want our flow because they knew that it had certain characteristics to it that were undesirable. Those undesirable characteristics are sometimes just size. Very, very large institutional orders will continue to move markets, and it's very hard for a market maker who needs to buy and sell to be able to handle those sorts of risks. Finally, one thing that payment for order flow does, and it works very well in a retail context, is it decreases the amount of time that a market maker is holding risk in their inventory. So a market maker tries to make a bid-offer spread. One of the things that's not appreciated about why a market maker wants to pay for order flow is they want to find a larger chance that an order will offset one they've already had put into their books. And so for all of these reasons, when you take a look at and run mathematical models, you find that the retail flow is easier to make money on than the institutional flow. And if we combine them, by definition, mathematically, the average price will get worse for retail and better for institutional.
Mr. Blogren, in your testimony, you advocate for the SEC to develop a system for publishing the quantity, duration, and other terms for each stock loan. Could you explain how this would benefit the securities lending market?
Thank you for the question. The concerns that are raised around short selling need to go upstream further and understand that short positions are established with a stock loan. And right now, it's an entirely opaque part of the ecosystem. Dodd-Frank asked the SEC to promulgate rules in this space. We think they have the authority to do so, and it would benefit investors and issuers.
Yield back, Madam Chair. Thank you for the indulgence.
Thank you very much. The gentleman from Georgia, Mr. Scott, is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Chair Lady, very much. Ladies and gentlemen, there are great dangers to our financial services system when non-financial, non-verified information posted on social media platforms has more market influence than what is disclosed through our regulated process. And we on this Financial Services Committee have spent years debating the standard of care for financial advisors, for broker dealers, and investment advisors. It was a suitability standard for the financial advisors. And then there was a movement for a fiduciary standard. And then the SEC came out with the best interest standard. Now, regardless of where any of us on this Financial Service Committee stand, Democrats or Republicans, with regard to best interest versus fiduciary, we all agree that there should be some sort of standard, which leads me to this current situation we're in today. Where is the standard of care as it applies to Robinhood? This isn't the first time that Robinhood, a broker-dealer whose stated mission is to democratize our financial system, has failed to provide critical protection to its investors who have suffered greatly as a result. For example, what standard of care is present when an inexperienced trader can take out $30,000 in his home equity loans to make a very speculative trade? So how under standards of care is this allowed? Should Robinhood question the source of funds when consumers are borrowing money on their credit cards to speculate on risky trades? Should those who post on Reddit or other social media sites be required to close when they stand to benefit from encouraging others to buy stock and drive up the price? Should the social media sites themselves be held to some kind of standard when investment advice is posted on their platforms? Now, obviously, Dr. Borgen, these are rhetorical questions, and I don't expect everybody in the panel to have time to answer, but here's my point. My point remains that there is a huge hole in our regulatory structure when we are dealing with individual investors using platforms like Robinhood to trade stocks and options and are relying on sites like Reddit for investment advice and ideas. Is it simply because a platform is considered high-tech that the traditional rules put in place to protect the investors do not apply? I think absolutely not. Now, Dr. Borgen, give me your thoughts on this predicament that we're in.
So I will say you make a very interesting point about the need for thinking about consumer protections. And I think a primary issue that we need to think about are the utilization of these behavioral science techniques to encourage users to trade in a particular direction. And these are new. This is kind of cutting edge behavioral economics and behavioral finance. And we're just now understanding the power of these. And so I think that it is critically important to understand, to regulate and understand these user interfaces. The behavioral biases are being exploited. And I want to make a couple of points. I want to say that even knowledge of a bias isn't sufficient for it to mitigate the behavior of a particular user. And mistakes are made even when it's a large dollar type of transaction.
Thank you so much.
Thank you. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry for holding this hearing today. As many of my colleagues said at our first hearing on GameStop, our focus should be on an equity market that efficiently allocates corporate capital investment to the best performing sectors of the economy, provides a powerful framework for risk management to those who take the entrepreneurial risk that makes our economy the best in the world. By and large, our stock markets do achieve these goals. With due credit to the financial regulation that followed the Great Depression, we need to keep in mind that regulation, like any activity, can eventually lead to diminishing returns. We captured the big benefits from rounds of regulation after the Depression and more modestly since then, but with the exception of maintaining vigilance over the ever-present incentives that the market has to innovate, we should be restrained in our recourse to regulation. The next round of regulation could have far fewer benefits than cost. Common sense must prevail in trying not to be too redundant. Bottom line, Mr. Pilar and Mr. Grodzic, what lessons have you learned so far from GameStop short squeeze, and what lessons, if any, should this committee learn?
Thank you, Congressman, for that question. This is just another example of lessons that I've learned throughout my career, both in government and the private sector. When anything happens in the market, whether it's a flash crash or the global financial crisis, or the trading activity here, or the volatility that occurred last March, is that, to use your words, we need constant vigilance in terms of innovation in the markets. And so the FTC has those tools, and those tools are what's called retrospective review of existing rules. So as you pointed out, there were statutes that gave the SEC authority to promulgate rules. The SEC promulgates rules that work at a particular time for a particular state of markets and technologies. And as markets and technologies change, as innovators innovate, the SEC, of course, has to revisit those rules. And so that's why in the majority of my recommendations in my testimony, I suggest that the SEC go back and reevaluate. When it comes to markets and technologies, it's particularly because they change all the time. So that's why the SEC has to go back and look at their regulations under the current market.
Thank you. Mr. Grodzic, you want to weigh in?
Yeah, I would like to add to that I think exactly as we just heard, we have to try to innovate in the regulatory environment to a changing world. And this isn't just a social media effect on finance. Social media, the effect on news, the effect on politics, and the effect on finance is both, I think, empowering in that it delivers a lot more ability for people to be heard, ability for people to hear alternate views, for data to be synthesized for their benefit. There's a tremendous potential data benefit for people, but we've also seen some real problems, and I think that's inherent in a societal change that is not yet settled into some sort of an equilibrium. It's been on my mind a lot. The Reddit discussions are in many ways quite worrisome. They create volatility in the markets, and volatility is generally bad. It creates all kinds of dislocations. Some of the behaviors are probably unintentionally actually market manipulation. When groups of people take action just to move a market price, whether it's a large player or small players, that's undesirable. There isn't a fundamental reason for doing that. At the same time, these are people that 30 years ago would have had to have gone to their broker and accepted that that broker knew better, and they would pay a whole bunch of money talking to that person on the phone and had no right to execute their own trades. So the real trade-off is, as we empower people, it also creates situations where that empowerment can lead to actions we didn't anticipate. We really need to think this through, but I believe we need to move forward. I believe the changes we're seeing are in the right direction. I think we do need to start to have a balanced view on which of these are bad for markets, bad for individuals, and try, and again, it's cost benefit. Everything we do to restrict things always has a cost, and we just have to carefully weigh that against the benefits of how we're going to handle this new world.
Okay, my time's going to expire in 10 seconds, so I'll yield back the balance. Thank you.
Thank you very much. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair, and thank you ever so much for the hearing. Madam Chair, I'd like to submit for the record an article styled "Hot Stocks Like GameStop Seem Fun Until You Look Beneath the Surface." This can be found at NBCnews.com on their website.
Without objection, such is the order.
Thank you. I'd like to read just some excerpts, if I may. Payments for order flow are banned in other countries. And some of those countries would include the United Kingdom, Australia, and Canada. I'd also like to call to the attention of Ms. Goldstein the following. When a firm like Citadel executes orders, it also receives valuable information on the direction a stock is likely to take. Market maker firms handling flow get to see unfulfilled orders from customers at specified prices the market hasn't hit yet. These include a type of sell order known as a stop loss, that's triggered at a price below the prevailing market price. Knowing how many stop loss orders are awaiting execution and at what prices signals where the floor is in a stock. It's information any professional trader would covet. And it also goes on to indicate in this article, it's not trade by trade that matters. It's the aggregate of them all that allows you to figure out which way the market is going. With this said, and understanding that Citadel has a disciplinary history totaling fines of $124 million in recent years for misconduct over a 3-year period, including trading ahead of customers who were forced to pay $34 million more for their trades. And over the same period of time, Citadel realized revenues totaling $13.2 billion, $124 million paid in disciplinary fines, but Citadel had revenues of $13.2 billion. So Ms. Goldstein, it looks to me like we can have a circumstance where taking the risk of getting caught can be built into your cost of doing business, such that you're willing to take that risk because of the possibility of having such great gains. Would you care to comment on this, please, ma'am?
Congressman Green, thank you for the question. I agree with you completely that too often I think violations of the law are treated merely as the cost of doing business. And I think that there are a number of things that we could do to avoid that in the future. One of the things that the regulators could do, for example, is to eliminate no fault, no penalty settlements where they don't require the firm that they've taken the enforcement action against to admit any wrongdoing. Another thing, and this is something I believe that you yourself have looked into in some of your legislation, is to go after not just firms, but individuals. So one thing you could do, for example, is create an attestation either for the CEO or other executives or the board of directors that there is some particular wrongdoing that they are also responsible and will, may face criminal penalties. And I would just flag that there are 2 other things that the regulators could look at, and that would be implementing Dodd-Frank Section 954 or 956. Section 956 had a rule proposed that was never implemented, prohibiting incentive-based arrangements that the agencies determine encourage risk-taking. So I think there are a lot of things that the regulators could do to help prevent recidivism by firms.
Thank you. A quick follow-up. It seems to me that knowing the direction the market is moving in, having the ability to high-frequency, high-speed trade, get into the market, take advantage of that, knowing that you have clients that are following you, that are going to buy into it, it gives you the opportunity to literally commit what I see as a fraudulent act, because you know what you're going to be able to pay for it. And you also know by going ahead of your clients, which is not permitted under these circumstances, you now get to buy and sell in such a way as to defraud your clients. Your thoughts?
Congressman, I think it's a good question. Citadel and other market makers undoubtedly have huge amounts of data as a result of the orders that they receive, both the ones that are executed and the ones that are canceled. And I think regulators should look very closely if there have been subsequent violations like the one that you identified where Citadel was in fact found to be trading ahead of its customers. I hope they continue to scrutinize them.
Is this a form of self-dealing? You say yes or
Congressman,
no?
I think it's a question for the regulators.
Thank you.
Thank you. The gentleman's time has expired. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Okay, let's go into.
Thank you, Madam Chair. My first question is for Mr. Blogren. In my opinion, the market self-corrected itself on multiple occasions throughout the events in January surrounding GameStop. I asked the question of the last witnesses in the last panel, and I've since talked to lots of folks involved in the financial services world with regards to these issues, and they seem to agree with that. Institutional investors overly shorted GameStop, and retail investors were able to take advantage of those extreme short positions. In addition, Melvin Capital and Robinhood were both in need of capital infusions and found it through the private markets. Mr. Blogren, from your seat at the New York Stock Exchange, do you believe the market was largely able to correct itself throughout the events in late January?
Thank you for the question, Congressman. Certainly the market infrastructure performed in a very resilient, very stable, very predictable fashion, which I think is critical for investor confidence. And I would agree that there were no systemic issues that that were presented. I do think, however, and I think the existence of multiple hearings on the topic suggests that there was a fascination with what happened in these particular stocks of itself is a cause for concern if it erodes investor confidence. So while we have the best markets in the world, there's always an opportunity to further perfect them.
Well, in response to that, yes, it's an unusual situation, but I think my question is, because it was an unusual situation, and we're having these hearings to see once if there was a problem here, if there is something we need to do, was there fraud, was there somebody else doing something illegal or wrong, and yet the system appeared to work in that the retail investor saw an opportunity to see an overly shorted stock to bring the pendulum back, so to speak, and the companies that had overly shorted it were able then to find money in the markets to shore themselves up. I think it shows that there's some resilience there. And to that point, SEC Commissioner Allison Lee recently wrote in a letter response to Senator Warren, and I quote, it does appear that our core market infrastructure has proven resilient through these recent events, as my colleagues and I have noted. To date, the commission staff are not aware of any structural issues resulting from the recent significant volatility in the price of certain stocks that indicate a disruption of core market infrastructure. So, Mr. Pivovar, would you agree with that statement that the market infrastructure remains resilient?
I would, but I definitely have not seen any problems with the market infrastructure. But as this episode pointed out, that doesn't mean we can rest and assume that it's going to continue, whether we want to think about shortening the trade settlement cycle.
Well, I think, I've got some questions on that, but I also have, to me, as an outsider, look shorted than there is stock available. Do you think we need to limit the amount of number of shares that can be shorted? Or do we limit, to me, this will be a way to fix the problem versus other extraneous things to me, that the market actually, so would you like to respond to that?
Sure, thank you. I think before the SEC looks at either limiting short selling or looking at potential limitations there, I agree with Mr. Blomgren, and we need to start upstream, right? The short selling market relies on securities lending, and to your point, same shares can be lent out multiple times, and you can end up with the odd situation where you end up with a short interest exceeds the number of shares that's outstanding. Right now, that securities lending market, the SEC could go in and gather up information on an ad hoc basis and try to piece together what it looked like in the past, but it doesn't have real-time information. It doesn't have consolidated information. And so it's in the securities lending market, and the SEC does have authority there to do that. And so my suggestion would be, first, let's gather the data, and then based upon that data, we can make additional policy decisions going forward.
Well, to me, the number of times that you can lend a share, to me, like you've got a situation that's ripe for musical chairs with your money there. So my time is up. I yield back, Madam Chair.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5.
Indisposed, but I didn't want to miss this meeting at all. So thank you. Let me associate myself with the comments that's labeled this committee hearing today. GameStop, who wins and loses when short sellers, social media, and retail investors. Let me ask this to Ms. Gold's of short media. When there is a collision, when there is some congestion, who wins and who loses, and is that predetermined?
Congressman Cleaver, thank you for the question. I'm also sorry to hear you're indisposed. I hope you feel. I used to work at Morgan Stanley. They had incredibly profitable days when there was volatility. The same was true at Merrill Lynch. They just have these certain inherently larger and larger force in the marketplace. So it's not just the large banks, but I think Citadel Securities in particular, in this particular situation, has profited quite well because they take up such a large portion of the retail order flow. And I think one of the things that the CEO of Citadel, Ken Griffin, said the last time he came before this committee was when no one else could provide liquidity, Citadel was there. And I think he was very proud of that. But I think that actually—
Your response, strong investor protections and making sure that we maintain a fair financial system. Are there any of the panel members? Because he's right on target. So you then believe that we need to do something, that there is some legislative cure financial system. Do you agree with that?
I had my thoughts here, if I could. Regulations that protect my experience of the signaling and capital allocation mechanism. We have to achieve certain positive results within the analysis, empowerment, because the last thing I just want to say is an individual has a very hard time having the same capabilities as an institution, but technology can bring them closer to having those capabilities.
Yeah. Thank you very much. Thank you, Madam Chair. I yield back the balance of my time.
Thank you. The gentleman from Michigan, Mr.
Gratifying for all. Second article, Greenwich Associates report the impact of zero commissions on retail trading and execution. And then third, a February 16, 2021 Cadwalder cabinet memorandum, GameStop regulator should focus. I appreciate that. Well, let me start there. It seems like some of my colleagues, with that last one, we need to improve the situation. And I think some of my colleagues would maybe of mine because these, these are not people who should be investing their own money, much less my money. And I know some people who are not to have that ability. And what it's are going to have access. And I'm here. We expect that kind of thing. Same thing. I've got one of the classics, and 30 minutes. The same is happening with their own investments. We shouldn't be looking at investing as something that only grandma and grandpa do. It should be approachable and accessible and malicious intent. And what I'm hearing a number of folks talk about is that eye candy equals malicious intent. And in your knowledge, has the SEC ever regulated on advertising style or on product delivery platform?
The SEC has with respect to like that. But to your question directly.
No confetti. That's not something that has to do with materiality, correct?
That's not something that we looked at when I was at the commission. Okay.
I've got a couple of things I want to hit on. The FTT rebate system, that maker-taker system. What would be the effect of an FTT, of a financial transaction tax?
The benefits would have to be defined. The cost would be that it would increase, obviously, the cost of transacting. That would decrease the number of transactions and the liquidity in the market. That's just an effect of having any kind of a friction. So you would get some amount of decreased liquidity, some amount of decreased transactions, and some amount of loss of signaling of optimal prices, because there would be certain price points at which people wouldn't participate because the tax would price them out. The size of the tax matters.
Okay, Mr. Pivovar, has this, while you were at the SEC, did you guys ever do a study on this?
On financial transaction taxes, no. But when I was in the White House during the Obama administration, I was asked to do a memo to some senior advisors. And based upon that memo and some other information, they decided not to pursue a financial transaction for the reasons Mr. Gruchik pointed out.
I'd suggest you trot that back out. So with that, I yield back.
Thank you. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Huizinga was talking about classical movies, and this whole GameStop thing reminds me of two classics. One is The Sting, and the other is The Producer. So The Sting, somebody had a little information earlier than the rest of the folks and was able to parlay that into some wins. And The Producers was about overselling a position. So I want to start with overselling a position. So Mr. Kelleher, in the previous hearing, and I think Mr. Luke DeMeyer was right on point, and I really want to understand this area. In the previous hearing, I asked Mr. Plotkin of Melvin Capital whether his firm was ever naked short selling on GameStop stock, and he said, no, the systems won't even allow that. That would be impossible for us to do. Yet, according to a report from Bloomberg Government, which analyzed the SEC data, $359 million of GameStop shares failed to deliver or be covered, suggesting many of the shares had been borrowed more than once. I think Mr. Plotkin's testimony was truthful, but can you explain what's happening when so many shares fail to deliver?
Sure. Thank you for your question. The current regulation only requires broker-dealers to have a reasonable, or institutional investors have a reasonable ground to believe the security can be borrowed, so that it can be delivered on the delivery date. So it's a reasonable belief. Now, I don't know about Mr. Plotkin's system, although it sounded like a pretty good system when he said it, which is he says unless his firm has identified, in fact, the security and to have it deliverable, it doesn't even allow them to short a position. But that's not actually the law, as I understand it. As I understand it, it's a reasonable belief, and that people can have a lot of reasonable beliefs. And we have massive failures to deliver of GameStop stock in January. So not only do we have a short position that exceeds about 140% of the available float at the time, but then subsequently we have a massive failure to deliver those securities at the time of delivery. So, and I'm sure, as Mr. Pivovar said earlier, the SEC is looking carefully at this, and I would expect their report to provide us with a lot more information. But as of right now, the publicly available information certainly indicates that there's a very high likelihood of some abusive short selling by somebody.
All right, so let me ask you this. So, I mean, Mr. Luke DeMeyer talked about sales 140% of existing shares. I mean, how does that happen?
Well, in the securities lending business, it happens because somebody lends a security to somebody who lends it to somebody else to lends it to somebody else. It goes by the technical name of rehypothecation. And what it does is you have this cascade effect where you, in fact, have the same security lent out multiple times. And then arguably you have short sellers having a reasonable belief at a period in time that that's the security that they could reasonably deliver at the delivery date. The problem is that that security has now moved to somebody else who has a reasonable belief that that very same security is the one he can deliver or she can deliver. And so the way the system works now, it's almost a house of cards. And I agree with several of the witnesses who said one of the things that needs to be understood and disclosed at a much more granular level is not only the activities of the short sellers, but we need to have greater disclosure and granular knowledge of what's happening in the securities lending market.
Thank you for that answer. So to something else that's kind of with penny stocks. And what we're dealing with here in GameStop and some of these others, very low dollar value initially kinds of stocks. Is there any limit to when something is delisted, Mr. Piwar? I don't know. I mean, should GameStop have been put on the pink slips at some point?
Thank you, Congressman, for that question. I may also defer to Mr. Blogrun for this, because the choice of listing and standards and delisting of stocks, as long as they meet all the SEC disclosure requirements based on the price, is up to the exchanges themselves. And they have very transparent rules on those sorts of things. So I'd leave that up to the exchanges to comment on that.
Thanks, Madam Chair. My time has expired. I yield back.
Ohio, Mr. Stivers is now recognized for 5 minutes.
Thank you, Madam Chair. I appreciate this hearing and a chance to ask some questions. My first question is for Mr. Piwar. Well, let's kind of set the table, Mr. Piwar. Retail investors, in this GameStop example, didn't the retail investors win?
Well, thank you, Congressman, for that question. We know there was a lot of trading in the security. We know there was a lot of retail-sized orders in the security. We know that for every transaction, it's a zero-sum game, so there's a winner and loser. I'm not sure we have data in terms of who the net winners and losers were. We certainly had a situation where retail investors were empowered with full information about the risks of the securities and full information about the price of the securities at any point in time. And so some were probably winners and some were probably losers.
Sure. And so let's dig in a little more. There are some legitimate issues around this, including settlement time, and T+2 forces some of the broker dealers, including the folks like Robinhood, who have an app to put up collateral and capital based on the time to settlement. If we were to shorten the settlement to T+1, or not quite, instantaneous, but T plus something less than a day, would that have resulted in less capital required by Robinhood? And would it have then resulted in allowing some of those retail investors whose opportunities to have a buy order were cut off to keep buying the stock?
In a short answer, yes. And more importantly, it would have taken additional risks out of the system. So the longer the settlement cycle, the more market risk, counterparty risk, liquidity risk that you have from failures to deliver. So one side of the trade doesn't get either the securities or the cash delivered, and maybe the market has moved against them, and so there's an adverse selection problem that's there. And then also systemic risk is taken out of the system to the extent that you have a large number of delivery failures within the clearinghouse across a number of brokers. But as you shorten the trade into the settlement cycle, I think, as Mr. Gruchik pointed out, is that you also run the risk of, if you try to get too close to settlement, to real-time settlement, you potentially have the operational risk. And the reason for that is you have to have multiple systems that have to be operating at exactly the same way. In terms of why are we at T+2? Well, I'll raise my hand. It was me. When I was acting chairman of the SEC, I brought us from T+3 to T+2. At that time, 4 years ago, going from 3 to 2 based on cost-benefit analysis was the easy regulatory layup or slam dunk, whatever analogy you want to use. But we also recognized in our final rule that technologies change, markets change, and it would probably get to the point where we should probably move to T+1, potentially consider real-time settlement, although I think that's probably a bridge too far. So in the final rule, we directed the staff to conduct a study of potentially moving to T+1, also looking backwards and seeing what were the benefits exactly of T+2, and do an updated cost-benefit analysis to see if it's time to move forward. That study was due to the commission back in September. I've publicly called for them to release that study. Congressman McHenry and Senator Toomey sent a letter to the SEC to release that study. So I think this is definitely something they should put out in the public domain, and we should have a debate about.
And for sure, we're closer to being ready for T+1, maybe not real time settlement because there are some issues around that, but T+1 would have helped solve this problem. Let's take another step backward. Some of these new apps and with zero commission trading and partial share trading, you're seeing more retail investors have an opportunity into the markets. Isn't that a good thing?
Yes, to the extent that their brokers are complying with all the federal securities laws, absolutely it's a good thing, right? And there's often a comparison made to the fact that, you know, retail investors on average, when they trade on their own, maybe overtrade a little bit, maybe don't do as well as if they were to put their money into passive index funds. You have to remember, first of all, that's an average, right? There are some investors that do quite well and some that don't do so well. There's also the opportunity for younger Americans to learn that maybe they have an aptitude for trading, or maybe this is a career for them that they otherwise would not have expected, right? Maybe 10 years from now, we'll be seeing an interviewer, somebody interviewing the top hedge fund manager on CNBC, and they say, well, how'd you learn to trade? And they say, well, I learned to trade from one of these trading apps and found I had an aptitude for it. So there's a lot of benefits from demand. And then also, obviously, for saving for retirement, people learn over time from their mistakes. And then maybe move into more passive investments that are better for them. But there's no substitute for learning.
Thank you.
I yield back.
The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes. Mr. Sherman, you have the gavel.
Thank you, Madam Chair, and thanks very much to our witnesses. Very interesting conversation. And I'm really excited to follow up on Mr. Stiver's line of questioning. He asked, didn't retail investors win? And Mr. Pivovar had a view of that. And I want to explore that a little bit because I really think that education here is important. So I want to devote a couple minutes to that. Are retail investors winning when they support the right of people to do what they want with their money? I can go to the window behind me and peel out $10 bills and throw them out the window. I can drive 20 minutes and be in a casino where I know I will lose money a little bit more slowly than throwing it out a window, but assuredly I will lose money. So look, we're a free country. People have a right to do what they want. But that's not what we're talking about here. What we're talking about is investing in savings. And I keep hearing people say that this is about building wealth and saving for education. So I want to figure out whether what we're talking about here is saving and investing, or whether it is gambling, which was a word that was sort of somebody cast shade on that word. By the way, I think we may be a little complicit in this. We were all excited. Let them trade, we said. And we featured Mr. Keith Gill, a retail trader known as Cat or something, who apparently made some money. But I've reviewed the literature here. There is no ambiguity. I've looked at the academic studies. I won't list them all, but Dalbar's got one out there, Barker and Odeen. It's very, very clear what happens when retail investors trade a lot. Mr. Kelleher, in terms that the folks watching at home can understand, what happens when retail investors trade a lot?
They lose, and they lose consistently. And they lose because they're paying more for every single one of their orders, because we have a order routing system that is intentionally complex and designed to extract the maximum amount of wealth from the retail investor. And that's
but it's not just that, Mr. Keller. I'm sorry, let me interrupt you. Thank you. That's what I thought you would say. But it's not just the structure of the system, right? When you look at the literature, retail investors lose because of a whole series of human biases, because they don't have teams of PhDs studying the stocks that they're buying, right?
Well, absolutely. You know, it's like saying that let's send the local Little League team up against the New York Yankees or the Boston Red Sox or the LA Dodgers. Frankly, you have these institutions that have maximum informational advantage, maximum technological advantage, maximum sophistication. They get to use all of that they have paid billions for the purposes of extracting wealth.
Right. And Mr. Pivovar is not wrong, right? I mean, there's going to be a distribution curve here. There will be some people who get lucky or who are at the narrow end of the curve or who do win. But on average, retail, again, for the folks at home, the more a retail investor trades, the less well they're going to do from an investment and savings standpoint, right? There's no ambiguity in the literature about that, is there?
None at all.
Okay, so this leads me to my second question. Mr. Tenev, who runs Robinhood, annoyed me a little bit because he told this committee that his customers made $35 billion. Mr. Arnick, you're a trader. If I told you that last year my portfolio made $3,500, would you be impressed?
No, I wouldn't. And what's really interesting about the individual anecdotes is everyone's got an anecdote. I have a young man who's very close to my family call me up saying on Robinhood, he bought a certain stock much higher, and he asked me my advice for what he should do. And he asked me specifically, should I put out a put? And I said, do you even know what a put is? Do you know how to trade options? He's like, yeah, I'm enabled to trade options. I said, what's a put? He said, it's when you put out stock for sale. All right. So the very problem here is that we have a broker dealer that's abandoned its suitability, its education and its suitability requirements. And it's done so because it has this massive incentive to do so.
Okay, I got it. Thank you. I appreciate that. By the way, do any of the witnesses quibble with the conclusion that I think I've been able to tease out here, that the literature shows that lots of trading by retail investors is really not going to be a wise investment strategy in the aggregate? Do any of the witnesses dispute that? Okay, no. Hearing none. Look, let me be clear again here. I believe that Americans should have the right to do with their money what they will. But, and let me close, Mr. Arnick, since you're an investor, what's a smart strategy for a retail investor who actually wants to make money and save and invest successfully?
I don't know if I should answer. He should dollar cost average monthly into Vanguard index funds and buy and hold.
Thank you. I yield back the balance of my time.
Gentleman's time has expired. I recognize Mr. Barr from Kentucky.
Thank you, Mr. Chairman. I have to say this is an interesting conversation, and when I hear some of the testimony, I do detect a paternalistic hostility to what I consider to be the foundation of our free markets, and that foundation is the freedom to take risk. It's paternalistic because I hear an elitist sentiment that only sophisticated, only highly educated or institutional investors know what they're doing. And government should intervene to restrict commission-free trading to protect retail investors from themselves, that government knows best and retail investors are simply not smart enough to allocate their own capital for themselves. I think there's hostility because it sounds like some of the witnesses want to pull risk-taking completely out of the system. Let's be honest, that is code for doing away with free market capitalism. Now, this is the second of what is expected to be a 3-hearing episode on this topic. The majority has concocted a series of villains in this saga. The first, it was the hedge funds who supposedly collaborated and colluded with Robinhood. Then it was the practice of short selling. Then it was payment for order flow. Now it's the so-called gamification of investing, as if creating user-friendly platforms that attract wider swaths of investors is a bad thing. Provided that no securities laws are broken or consumer protections are compromised, it's not the role of Congress or regulators to dictate the constructs of a user experience. If investors like the platform, it will succeed. If they don't, it won't. Mr. Pivovar, how might additional poorly tailored regulations on financial technology like app-based investment platforms slow the expansion of retail investor participation in the capital markets?
Yes, thank you, Congressman Barr, for that question. One of the concerns about slowing down access for retail investors is the equitable access. What disparate impact will it have on low-income households who are already put at a disadvantage from the accredited investor definition? And if I may just address, I think there was a straw man argument brought up by Congressman Hines. There's not this world where people are putting all their money into a Robinhood app and trading all of their portfolio all the time, or they're putting all their money into a Vanguard index fund. What we see is that a lot of investors are very sophisticated. They put some of their money into passive index funds, low cost, and then take a little bit of it and try to generate a little bit of alpha and see how good they are at it. And some win.
Mr. Pivovar, that's a very good point, and I think we shortchange the intelligence of some of these retail investors when we just assume that they are not diversified. Let me ask you another question about payment for order flow. Would restrictions on payment for order flow or an outright ban on payment for order flow impact price improvement for retail investors? And if so, what would that impact be?
Well, so the first likely event we're going to see is that we're going to return to commission-based trading. Free commission trading would go away. Again, that would have different impact. And the second point I would make is that if we're back into a world where there's another conflict of interest, and that's the churning of accounts in order to generate commissions, right? So it's been said in the testimony that there's an incentive to generate revenue by more trading for payment for order flow. That same incentive exists in a world where you have commission-based trading. And in a prior part of my career, I actually worked as an expert witness on behalf of plaintiffs who were arbitrating against in broker customer disputes in a FINRA arbitration for churning accounts. And so, again, that's another thing that just has to be monitored for compliance and enforced.
And I don't have time to ask the question to Mr. Grujic again, but I think his point about forcing a combination of retail and institutional flow will have a negative impact on price improvement for retail investors. And I think that stands repeating and an unintentional consequence of excessive restrictions on PFOF. Final question, Mr. Pivovar. Mr. Kelleher and some of the other witnesses have argued today that existing best execution requirements do not sufficiently address what they consider to be conflicts of interest associated with payment for order flow. Do you agree? And has payment for order flow in any way canceled broker-dealers' duties to route customer orders to achieve best execution?
So the answer to your last question is no, they have not canceled that. What I've said in my testimony is a multi-factor, multi-dimensional thing that the SEC looks at. And so markets change, markets evolve, technology evolves. Of course, the SEC has to represent that. But there's been no diminishing of it. In fact, the SEC vigorously enforces the best execution rule.
Thank you. My time has expired. I yield.
Thank you. I ask unanimous consent to put in the record a 2016 report from the Chartered Financial Analyst Institute that found that following the UK's ban on payment for order flow in 2012, the portion of resale size trades executing at the best quoted price went up substantially. And I recognize Mr. Vargas, my colleague from California.
Thank you very much, Mr. Chair. And again, I want to thank all the witnesses for being here. I heard a speech toward the beginning of this hearing that we Democrats want to, quote, enhance inequalities. And I always find that an amazing and staggering quote when my good friends on the other side of the aisle give a $1.9 trillion tax giveaway to the wealthiest Americans. I always find that interesting. And the other notion that somehow we're paternalistic and we should allow people to trade and to be able to do all these things, which I agree with. But however, here we have a defined benefit plan in Congress where we can't make those decisions. So I always find that interesting. Now, there seems to be an inherent conflict in this payment for order flow, that the retail investors get the worst execution. And I'll quote some of the statements made here today. It's really a wealth extractor for the few. Legalized kickbacks coming from retail investors. So, Mr. Arnott, should we prohibit payment for order flow? We just heard something put into the record by my good friend, Congressman Brad Sherman. So should we prohibit it?
Thank you for the question, Congressman. I absolutely believe we should ban payment for order flow in all its forms. It distorts order routing. It distorts order routing on exchanges. It distorts order routing and best execution in the off-exchange markets as well. Consider this. Robinhood, with its carrot of payment for order flow, has a duty to get best execution, as well as the suitability I referred to earlier. But to get that best execution, they would need to access the 20% of New York Stock Exchange midpoint orders that are the 50% of the orders and trades that take place in the market that are odd lots, which are predominantly what so many of the Robinhood traders are trading due to their small account size. Yet, why can't Robinhood do that? Because they aren't even connected to any of the exchanges. The only relationships that they've developed are wholesaler relationships where they receive payment for directing orders to high-speed market makers uniquely tooled to profit over those orders.
Thank you. Mr. Kelleher, would you disagree with anything that you just heard from Mr. Arnott?
No, he's exactly right. And in fact, I would go a little bit further. The Congress doesn't have to ban payment for order flow. The SEC should take the position right now that payment for order flow violates or facilitates the violation of the best execution duty. We know for a fact that today, about 47% of all trading is happening off exchange in dark, unregulated markets. None of that flow goes to the public exchanges. And we also know that the trading in those exchanges get worse execution than they do on the public exchanges. And what has happened over time is this artificial construct of best execution based on what's called the NBBO, the National Best Bid and Offer, on the exchanges. So they're claiming, and Mr. Tenev said this last time, we got price improvement. We do great for our customers. According to what? It's according to the NBBO, but the NBBO only reflects about 40% of total orders, and the least liquid market that there is at the time right now, which is the lit markets. And Mr. Arnott is right. It doesn't include odd lots, and it doesn't include, by the way, gray market, hidden trades, also the 20% of the market. So what they're saying is we do great things. You can look at this. We do price improvement. We do better than the NBBO. But both of those benchmarks are misleading, if not intentionally false. And the SEC should take the position that that violates the duty of best execution today.
Let me ask Ms. Goldstein, would you agree?
Congressman, it's a great question. I think that, there are a number of ways to approach this problem. I think you could prohibit payment for order flow. I also think that you could ask that brokers have to pass on payment for order flow to their customers, or allow their customers to opt out of payment for order flow. So I don't know that there's a single solution for how we address this, but I do think that it does need to be addressed in some way.
So let me go to Mr. Blaugrund. How about yourself? You represent an exchange. Should we prohibit it?
I think there's a real public interest in having the broadest set of market participants interact with one another from an order flow perspective. That being said, I think the SEC has announced their plans to study the question of whether payment for order flow is consistent with best execution obligations, and we look forward to reviewing their findings.
Thank you very much. Yield back.
I see our chairwoman has returned, and I'm happy to return the gavel to her.
What's the next person?
Madam Chair?
One moment, please.
Okay.
Who's up next, Mr. Chairman?
It's been suggested to me that at the request of one of our witnesses that we take a 5-minute break. We can do that, or we can move on.
Without objection, let us take the 5-minute break. The committee will
is over. Now recognize Mr. Williams from Texas.
Thank you, Mr. Chairman. I'm very concerned that there is going to be a federal overreaction to this whole GameStop saga. CBOE's volatility index, better known as the VIX, has historically been used to gauge fear in our capital markets. When this number is approaching record highs, people are uncertain on the direction how that market will move, and investors, quite frankly, get nervous. Just 1 year ago, in March 2020, the VIX reached an all-time high of 82, and the Dow Jones proceeded to crash by 26%. On January 28th, the day that we have now dedicated 2 full committee hearings towards, and with more planned in the coming months, the VIX was in the 30s, and the change in the overall market barely even registered. So while a few stocks such as GameStop may have seen some historic individual metrics in January, none of these individual securities appear to have posed a systematic risk to the markets as a whole. So rather than pursuing radical changes to our capital market structure, we should be looking at the very tailored issue that prevented retail investors from placing trades on securities that day owned when they wanted to. So, Commissioner Pivovar, can you discuss your views about how changes to market structure should be done, and if it makes sense for Congress to step in now instead of waiting for the SEC study that issue and go through a thorough rule-making process with a cost-benefit analysis?
Thank you, Congressman, for that question. Having served both on the staff of the Senate Banking Committee and also serving at the Commission, I feel like I can address this question. Because markets and technologies change all the time, I believe the SEC is better positioned to look at these changes and put it through their cost-benefit analysis. So the SEC is bound by statute, by a number of statutes, to take into account the costs and benefits of various alternatives that are out there, including the baseline scenario of what the existing situation is. So, for example, shortening the trade settlement cycle. The current situation is T+1, and they could evaluate that through the lens of cost-benefit analysis and say, well, what would be the relative costs and benefits of going or at T+2, what would be the relative costs and benefits of going to T+1 or T0, and explicitly look at those. Same thing in payment for order flow. They could look at likely effects. They can get the benefit from market participants, investors, academics, take all of that information in and adjust their regulations accordingly within the broad context of the federal securities laws. Now, that does not mean Congress doesn't have a role here. I think you all have a very important role here. To the extent that you think any of these market structure or market infrastructure policy changes should be prioritized by the Commission, I believe that would be an important role for this committee to try to come together and find consensus on what are the 2, 3, 4 most important areas for the SEC to focus on, because as you know, you've given them a broad mission with broad authority, sometimes for prioritizing those.
Okay, thank you for that.
Tell
Secondly,
you to find out what happened with
any American to be able to put
progressive
some of their hard-earned paychecks in the stock market and have the same ability to succeed as any large institutional investor. Unfortunately, many Americans believe that the system will always be rigged against them, and they have no way to compete against the big players after watching this situation play out. Whether that view is warranted or not, we need to be working to continue to empower the retail investors. So, Mr. Blogren, I know there has been a lot of conversations around access to market data. Can you talk about the New York Stock Exchange and what it's doing to get better market data into the hands of the average American looking to make more informed investment decisions?
Thank you for the question, Congressman. NYSE publishes market data through the consolidated tape, which is an industry-wide utility, and also through proprietary market data products. All of these products are filed with the SEC, available broadly and according to a standard rate card. In general, the retail community consumes market data through the consolidated tape, which has largely kept prices steady for many years. The retail investor typically has their market data paid for by the broker, and it costs about $1 a month. Microseconds.
Thank you, Mr. Law.
as much trading volume as NASDAQ. Further, Citadel Securities, a maker of two financial. With respect to, can you all speak?
Suppose that about is whether the banks fail, because amount of competition within that, capture that market share. And with us,
and that the SEC in their exam process in this current period will be looking at that as a special exam. There's no doubt about that in a non-commission world. So I would say, does the competition among market makers under payment for order flow or not really improve that spread and thus lower the cost to retail investors?
Thank you, Congressman, for that question. We do have some insight into that. So as some people have mentioned, there is some transparency on this issue. So the SEC requires each of the market makers to file execution quality report in the language of the SEC Rule 605 reports. And so we can see, for example, for Citadel is the one that comes up. We can see for them, or whatever any other market maker has to put out their statistics, and we can look at things like the speed of execution for various order types and what's called price improvement for those various order types. So we can actually see, measured against the national best bidder offer, whether in fact they're offering net price improvement, whether they're executing at the spread or whether they're executing outside the spread.
Yeah, that's helpful. And also, Mr. Sherman talked about the lit market, those quotes that go across an exchange. But as noted by our friend from the New York Stock Exchange this morning, all quotes are presented at retail in milliseconds, whether they took place off the exchange or on the exchange. Is that correct?
That's correct.
Yeah, thank you. I also was concerned, my friend Mr. Green from Texas made some comments about Citadel, and we had obviously some discussion just a moment ago about Citadel Securities. And I was curious as to your views about the separation of businesses owned by Citadel. So Mr. Green's allocation, I don't want to put words in his mouth, is that somehow Citadel could use the information that they garner from being a market maker, payment for order flow, understanding the stop loss position in a number of names, and somehow trade on that information over at Citadel's hedge fund. Really, I found that shocking. That's against the law, is it not, Dr. Pivovar?
Absolutely, it's against the law. The SEC has put in place a number of restrictions, and so effectively, the hedge fund and securities market making divisions at Citadel have to operate separately. The SEC regularly examines to make sure that those that they've put in place proper protections in there, and if they find that any firm is violating those, they will vigorously enforce them.
Yeah, thank you. Mr. Gruchik, I really appreciate your testimony. I really enjoyed learning about your company today. Discussion about the sales practices of Robinhood in the previous hearing. Quickly, could you address your policies on low dollar stocks, not penny stocks, but even if they're exchange listed, what your position is there or margin on your platform?
So we don't yet offer options on our platform. I have a lot of experience trading options, and we're thinking through how to best do that.
Research and behavior. Platform is designed and the user interface can almost on an uncorrectly traded stocks that just having attention to the investor to do so.
That encourages savings and investment.
And Mr. Hill said this has really been an exceptional hearing. That was when Robinhood servers go down. That is a heck of a statement. That's causal. Can you just comment on? Can you explain that in a little bit more detail and whether, to the degree you have any confidence in whether that's a correlation or causality?
Thank you for the question, Congressman. When Robinhood would have a technology outage, those retail orders would not go to off-exchange venues and would come back to the exchanges. And when those orders came to the exchanges, not surprisingly, more order flow migrating to the exchanges would narrow spreads. So first of all, that meant that the retail investors who are trading through any other app are getting narrower spreads and better price improvement and an improved experience and less costs. But it also means that the rest of the market, the institutions, the pension funds, the mutual funds that really represent 90% of the long-term investors, they're able to interact with that order flow on the exchanges. And that order flow, for the same reasons that the market makers want to monopolize it just for themselves, when it's participating in a diverse environment on a public sunlit exchange, the best outcome accrues to everybody with those narrower spreads and less toxicity on the exchange.
That's really remarkable. As I'm sure you saw last month when Robinhood CEO Vlad Tenev testified before us, he said that Robinhood customers received more than $1 billion in price improvement in the first half of 2020. Can you just tell us briefly, is price improvement a proxy for best execution?
No, not at all. Thank you again. Price improvement is an arbitrary calculation. It's based on a construct that we created, the national best bid and offer. So it does not include odd lots. 50% of the orders and trades on the exchanges are odd lots. And the NBBO does not include those. And those odd lots are in between the spread orders. So there's a whole mess of liquidity that demonstrate that the best available price is certainly not it rings false. It's not the truth.
Well, I want to then get to him with Ms. Axney was really remarkable about the trajectory of Robinhood shifting from flat rates to a % of the spread payments for their payment for order flow. But in his testimony, Mr. Tenev not only acknowledged that point, but said that in their options market, this may be true in equities as well, but he said in their options business, they categorically do not route trades to anyone with whom they do not have a payment for order flow agreement. So without speaking to Robinhood generally, if you are a brokerage that is earning your revenue as a % of the spread, and you are only routing trades to people with whom you earn payment for order flow, is there any universe where that is consistent with actually fulfilling your best execution obligations?
I believe absolutely not. They have no mechanisms to trade directly on any of the numerous venues that exist to trade. Dark pools, exchanges, these cost money. And apparently Robinhood is more interested on the revenue side of their business model than actually incurring cost where they can fulfill their duties to seek best execution, the best prices everywhere.
Mr. Kelleher, with 30 seconds left, is there anything you'd like to add to anything that Mr. Arnica said?
No, he's exactly right. I mean, frankly, the SEC should consider taking fraudulent action for people who claim price improvement off of NBBO because it's at best misleading, if not a fraudulent claim, and knowingly so.
Thank you.
Mr. Laudermilk.
Associate myself with Mr. Hill's comment earlier, these two hearings. I think it has been very informative discussions that we should be having. Now, with that said, in the first hearing on this topic, I raised concerns about the fact that some of my colleagues on the other side of the aisle were using this information in. Now, it's ironic, Robinhood in the first place, as relations at that time, but live in a political era that we know Elizabeth Warren and others are using this devastating financial transaction tax that would go in a free market system, which consumer, they know that there is a risk. The greater the risk you're going to have. That's just a basis as we're going forward and trying to make a risk-free environment, but with high returns. It's just a fact. I know of several people who have never been involved in the stimulus money, but I know that eventually these account because interest rates are so low, money markets using some of the stimulus money to invest, and they're concerned about some of what's going on. Now, these calls for more regulation, I think, are ill-advised and premature for multiple reasons. And witnesses at the first hearing said that markets are not broken, and the SEC chair and the SEC commissioners have said that core market infrastructure has been so far has not indicated that there was margins are actually filed. So my question, already regulated by the SEC?
A number of requirements that use of short selling, the illegal short selling. So regulation SHO, which was actually putting on the number of fails to deliver went way down. Now, again, that was 17 years ago. If there was that a rule that the SEC should possibly revisit, absolutely, they should be doing that, right? Options trading also is highly regulated by the SEC. There's a dedicated team within the Division of Trading and Markets that oversees just the options market. And the Division of Examinations and Enforcement team also have individuals that monitor for noncompliance in wrongdoing in those markets. And I apologize, was there a third one that you asked about?
It was the short selling and order flow and options.
There's we've talked extensively. The transparency of statistics are not apparent, more useful for investors so that we can actually see.
I'll submit the other questions for the record and I yield back.
Thank you very much. Ms. Presley is now
for convening this hearing and all the witnesses for joining us across the country is reeling from the economic impacts of this pandemic. February 2020, over 200,000 fewer people are employed. Children in 12% of households do not have enough food to eat, and many of the smallest businesses have permanently shuttered their doors. Research shows that following the 2008 recession, gambling and cheap lottery tickets increased among those who continued struggling financially. In this economic recovery, I'm concerned that Robinhood has positioned itself well to take advantage of this trend, but with much higher stakes for my lowest income constituents. Robinhood boasts that the platform is democratizing finance for the benefit of everyday Americans, positioning itself as the great equalizer of capitalism. Meanwhile, it's running targeted advertisements on social media that say, and I quote, "Millions of people will soon begin receiving stimulus checks. As you consider whether to spend, pay down debt, or save, we want you to be prepared." With a link back to their own blog, which says that, quote, "never investing at all is a missed opportunity." Many of my constituents now just have a $1,400 stimulus, or what I call survival check, in their bank account to get them through months of expenses, and are positioned to lose hundreds of thousands of dollars in options trading if they take that gamble. Ms. Goldstein, what do you make of these targeted advertisements under the guise of promoting financial literacy? Is Robinhood really increasing its own profits by attracting new users after many existing users left the platform due to the trading halt in GameStop?
Congresswoman, I have seen the same advertisements you are talking about. I keep getting them over and over again, in fact. And I do think that Robinhood, there was a survey that was done by Fortune in the wake of Robinhood freezing trading in GameStop and other meme stock names. And they found that some half of their users were considering leaving Robinhood for another brokerage in the wake of that. And so I absolutely think that Robinhood is looking to attract a new user base that hasn't previously perhaps participated in the financial markets to account for what I suspect is a large amount of users that they lost as a result of freezing trading in GameStop. And I should just flag that I disagree with the assessment that regulation is the reason that Robinhood froze trading, or that, the clearinghouse capital requirements is the reason. Most major brokerages have very serious, dedicated teams that evaluate the risk and the capital that they need to put forward every day. And I suspect it may be Robinhood's inability to manage its own risk and not any fault of any regulation.
Right. Well, look, providing an opportunity for people to make informed investments in part of their financial planning is not a bad thing. However, targeting the vulnerable Americans receiving federal relief during a pandemic certainly is. And this is not the solution to their hardship. Ms. Goldstein, Robinhood proposes that turning everyday Americans into day traders is democratizing finance. But you've written that the real solution to breaking the power of finance is to rebalance the recession-wrecked economy. What does democratizing the economy really look like?
Congresswoman, balance our economy so that everybody isn't struggling or looking for the next gold rush scheme in order to pay their rent if they're facing eviction. I mean, I think you've been a real leader in this space, and so has the chairwoman, and so has Representative Adams and many others who have called on the president to cancel student debt through executive authority. I think there are a lot of different ways that we can tackle this problem. But I think one thing that we should think about, and you all as policymakers can think about, there's no way to save for retirement right now that doesn't give a cut to Wall Street. Unless you buy a savings bond or unless you are rich enough to purchase a municipal bond, we always have to give a cut to Wall Street if we want to save for our future. And 47% of Americans have no exposure whatsoever to the stock market. And so they're not going to be able to use Robinhood to try and, make some wealth for themselves. And I think we need to come up with other solutions in order to figure out how we can build wealth. And there are a lot of potential solutions for that. The American Rescue Plan is a part of it, but I think we need to do much more. And I thank you for your leadership on the resolution on canceling student debt.
Thank you. I have tons of ideas. Canceling student debt, federal job guarantee, baby bonds. One thing's for sure, we need to be investing in people and in jobs, and thinking about transformational, bold policies. And that's what I'll continue to push for to close the wealth gap and to create opportunities in our communities. So thank you for being here today.
Thank you very much. The gentlelady yields back. The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. In the aftermath of the market volatility in January, Acting Secretary of the SEC, Allison Heron Lee, released a statement saying that the SEC would quote, act to protect retail investors when the facts demonstrate abusive or manipulative trading activity that is prohibited by federal security laws. So my question is for Mr. Pivovar, will you discuss the types of fraud that are currently prohibited and detail the breadth of securities laws that govern manipulation and false statements?
Thank you, Congressman, for that. I'm not sure I can address all of them in 5 minutes, but I'll maybe give you an overview of some of them, right? So one is, you cannot trade on material non-public information in the breach of a fiduciary duty. So that would be insiders having information that they are using to disadvantage retail investors. You cannot engage in manipulative trading activity, and that can take the place of doing, for example, the typical pump and dump schemes, where people put out into the marketplace and the internet, wherever, false and misleading information that would paint a rosy picture of a particular company, trying to increase the share price after they've already bought the securities. So they pump up the securities and then dump their shares at the high price and leaving retail investors holding the bag afterwards. You cannot engage in other manipulative trading activity. In the case of very high frequent trading, you cannot do spoofing and those sorts of things to give the appearance that you're providing liquidity and pull that away in order to induce traders to trade in those sorts of things. So there's all kinds of different securities laws that protect investors. I will also note that the SEC's enforcement division has a specific enforcement group dedicated to market abuses, and it's one of actually the most effective and most productive enforcement teams at the SEC in rooting out these abuses. You're on mute, Congressman.
Sorry, quick follow-up, Mr. Pivovar. You indicated in your testimony that you have confidence the SEC is well equipped to identify and act upon market manipulation as it relates to the GameStop case. Is that correct?
Absolutely correct. For the reason if one, they have the authority to do it, and two, they have an incredible enforcement staff, particularly the market abuse team is very good at looking at these. There's not only the enforcement staff in Washington, D.C., but also 10 different regional offices across the United States are looking into this.
All right. Well, I just want to say, listening to the interviews from some on the left, you might not realize that the SEC already has the tools to go after market manipulation. Instead, you would hear accusations from those from Senator Elizabeth Warren that our capital markets are rigged for the rich and powerful. If anything, GameStop case is an example of how lots of small retail investors can bet against a large hedge fund and win. It's not a rigged market, it's a free market. So when I hear some of the so-called solutions offered by my my friends, my Democrat colleagues that they put forward, I'm reminded of the quote from the great Milton Friedman. Many people want the government to protect the consumer. A much more urgent problem is to protect the consumer from the government. So as we hear these proposals from Democrats on these panels, I mean, I think we should ask ourselves, will this actually help retail investors? A couple questions like, would really restricting or banning payment for order flow help retail investors that benefit from no commission trading? Would a financial transaction tax benefit the retail investors that would be forced to pay it? The answer to both those questions is no. So instead of using January's market volatility to advocate for new legislation, we should allow and protect investors from these attempted, going to fail so-called solutions that will do more harm than good. Thank you, Madam Chair, and I yield back.
Thank you. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes. Is Mr. Torres on the platform? Not the Democrat. Not the Democrat.
Who?
Is Mr. Torres on the platform?
Alma?
If not, we're going to move to Ms. Adams. The gentlewoman from North Carolina is now recognized for 5 minutes.
Let's see. Thank you, Madam Chairman. Thank you very much. Thank you to all of the witnesses as well. Mr. Blogren, did the markets operate the way they were supposed to, or are there some fundamental vulnerabilities that have been exposed? From the vantage point of the stock exchanges, where, if any, are the existing weaknesses within the system?
Thank you very much for the question. I think as the SEC reported and as a number of the panelists have noted, the core market infrastructure operated very well. It was very resilient, it was very available. From the exchange's perspective, our job is really to do 4 things: ensure continuous price discovery, facilitate risk transfer, regulate our members' activity in the market according to exchange rules and securities laws, and then to ensure compliance of listed companies with their continued listing standard obligations. All of those functions operated well. However, it certainly is the case that the retail investor experience was uneven across retail brokerages. And it's the case that for a listed company like GameStop, you're left with a lot of confusion about how a modern market structure could result in your stock having such volatility in such a short period of time. So I think when we look at potential reforms for the marketplace, there are a couple relatively low-hanging fruits that we can focus on that would have significant benefit and reason.
These section, which currently is overseen by FINRA, should SEC to curtail forced arbitration for game.
Asked me to take over and represent recognize Mr. Davidson.
Reading through your